Hi, everyone. Thank you for joining this Risk Minds webcast on climate risk management. My name is Brittany Schmidt. I'm from PwC. I'm really excited to be moderating today's session. I'm joined from folks from across the UK, EU, and the US firm who've all been focused on ESG and climate topics. I'd like to let them introduce themselves. John?
Hiya, well, good morning if you're in the US and good afternoon if you're in Europe. Really great to be here. So my name is John Williams. I'm a partner with PwC in the UK. I lead our sustainable finance practice and also sit on the firm's global FS ESG leadership team. And I'm a member of the TCFD, the Task Force on Climate-Related Financial Disclosures. So you now know who to blame.
Thanks a lot, John. Nicole Rӧttmer, I'm a partner in the German office, but responsible for the climate practice in Europe, and at the same time for climate excellence globally. So any topics related to financial risk management and TCFD integration based on modeling. Had the pleasure to work on this topic for the past 20 years and work closely with the TCFD in the early phases, the G20 Financial Stability Board, and the advisory board for the Science Based Targets Initiative, working closely with 2 Degrees Investing Initiative. So very much looking forward to the discussion today and to engage questions from your end. Charles, over to you.
Great. Thanks, Nicole. Charles Van Althann, I'm a partner in the US firm in our risk and regulatory practice. I've been focusing lately on how to integrate climate risk into banks' enterprise risk management programs. Prior to that, I was at the Federal Reserve Board, where I was in banking supervision, focused on evaluating how firms manage and measure their risks.
So I guess that's me. Hi, everyone. I'm Steve Bochanski. So I'm a partner in the U.S. firm. I'm an actuary by training. I've been practicing as an actuary for over 20 years in the life insurance space, and I now lead a team of actuaries and financial engineers that's focused on climate risk modeling for the U.S. firm, cross-sector. But of course, our background as actuaries does give us a leg up in the financial services sector.
Awesome. Thanks, Steve. We're really excited to get this discussion going. So a couple of housekeeping items before we get started. I will be taking questions from the audience. Everyone should see a Q&A box on the bottom of your screen. Feel free to type in any questions you have there, and we'll see how many of those we can get to in today's session. We'd like for this to be interactive, so go ahead and fire away. We're ready for you. And with that, let's go ahead and get started. So let's go to you first, Charles. So the EU has been working on this climate risk topic and disclosures for some time. And globally, we're seeing a lot of momentum. But in the US here lately, it's really heated up recently. Why do you think that is? And what developments do you expect to see if you were sort of reading the tea leaves?
Yeah, thanks, Brittany. I mean, the mood in Washington, and the energy there around climate is enormous right now. The Biden administration came out right out of the gate noting that climate was going to be a major priority. They appointed the first ever special envoy for climate and immediately set out to accelerate the government and regulatory action related to climate risk. We've also seen action at the regulatory agencies with the Treasury, the Federal Reserve, and the SEC all appointing senior advisors, task forces, committees, other entities to essentially, take a look at how they're evaluating climate risk and what the potential impacts are. From the bank supervisory standpoint, where I operate a little bit more, they've appointed 2 very senior folks to oversee it. So the Federal Reserve took Kevin Styro out from a very senior banking supervision position, put him in charge of evaluating climate risk for as it relates to sort of bank stability. And then similarly, the OCC appointed Bob Phelps, another very senior executive. So just the fact that they're taking out sort of people who are considered to be top talent and putting them in these positions indicates a lot about what their priorities are going forward and where they think they need to position smart people with a track record of developing new programs. And certainly, climate is an evolving area similar to some of the other areas that a lot of these folks focused on over the last 10, 15 years.
That's really helpful, thanks. So I'm going to come out a little hot right out of the gate and ask you, Charles, financial risk impacts from climate change. Is it real? Do the firms that you're speaking with really believe in it? Or are they just, playing to their investors, regulators, stakeholders, and PR departments to make them happy? What's your take?
Well, I think whether individuals think it's real or not, I'm sure varies considerably from individual to individual. But one of the things we generally think about, and I think there's broad consensus around, is that people are taking on climate risk, whether they sort of like it or not, in the form of transition risk or physical risk. So, if there's significant amount of government action across the globe, there's going to be more transition risk, associated with that. If there's less, there will be more physical risk, and likely people are taking on both. And what I think one of the big things that I think differentiates climate risk and the evaluation of climate risk nowadays compared to sustainability movements and other things in the past is the fact that we're seeing real, tangible financial risks come out. In the United States, we had Pacific Gas and Electric go from investment grade bond to default essentially overnight. So we've seen real financial risk occur. And while I think there's the evaluation of the materiality will differ by firms' risk profile and the types of risk they're taking on, the duration of the risk that they're taking on, there's no doubt that there is real financial impact out there. How material it is to each individual firm will vary. And that's part of what firms need to focus on now is that sort of risk identification, risk measurement process in order to assess how much of a problem could this really be for us going forward, and what are the capabilities that we need to develop in order to be able to better assess how we're positioned. And John, I don't know if you want to add to that.
Yeah, I kind of think if, together with your clients and your staff, you're keeping your owners and your regulators happy, you're doing a pretty good job as a financial institution. When the TCFD was set up, it was set up because the Financial Stability Board and its then chair, Mark Carney, were concerned that, climate-related impacts were not understood by financial firms and certainly weren't being reflected in the market in terms of capital allocation and pricing. So that was the whole basis for the TCFD. Since then, regulators around the world are certainly seeing climate risk as more than an emerging risk, really becoming a sort of top risk, and particularly how it drives credit risk, market risk, liquidity risk, etc. I was talking with the CRO of a bank in Australia last week, and he was saying that they were seeing liquidity risk getting ahead of operating cash flows, i.e. that some clients in some sectors were now struggling to refinance, even though the cash flows would support the tenor of the bond, for example. So I think banks are taking it seriously. I would also say that with $182 trillion of financial assets managed by financial firms that have signed up to the TCFD, that's kind of 80% of the value of global capital markets. Then actually you've got a massive amount of commitment around climate. And then if I sort of one final point, I think it would be highly unlikely that any financial firm in the short to mid-term would face significant losses from physical climate events. The whole nature of financial firms is they're broadly diversified. So if you've got good diversification in terms of assets in your portfolio, then probably the major physical risk in the mid-term could be concentrated operating assets such as data centers that haven't been caught in a wildfire. I've got a customer that lost their data center in California last year, for example, for about 2.5 weeks. It's the transition risk, the impact of different climate policies and prices around the world that I think is going to hit much more short term. So last week, the International Energy Agency said there is no room for any more fossil fuel expansion beyond the end of this year anywhere in the world. And that's really, quite a stark change for an organisation that has generally been, sort of supportive of the energy sector. And certainly in Europe, we now see cost comparability between electric vehicles and petrol vehicles. And the auto companies know this. But if you're a supplier into the auto sector, you could find that the components that you were making for petrol cars are really no longer needed. You could find your whole business being stranded.
That's really helpful, John. So I think maybe one question I'll redirect on this one to you, Steve, is we hear some folks say there's insurance, right? I have insurance. So from a physical risk side, do I really see this playing out? Maybe you could speak on that briefly.
Yeah, I think I wouldn't recommend that as a strategy, just because we don't know what's going to happen. And I think this is why transition risk is such a big issue. First of all, we're not comfortable with it. It's not a risk that we're kind of used to managing, maybe in some aspects of regulatory risk, but I think the risk of the reinsurance pool drying up or government action, for example, some things that have happened in the U.S. and California, and the government preventing insurers from leaving certain markets. I think that's where I wouldn't sort of rely on reinsurance as a foolproof strategy.
Thanks, that's really helpful. We hear that comment quite a bit. All right, so John and Nicole, I know, oops, sorry, go ahead.
I was going to actually just follow up on that. And Steve, I mean, the presence of insurance may evolve over time, right? As risk profiles emerge. And I guess, how do you guys think about that from an insurance industry standpoint?
Sorry, Charles, the presence of reinsurance?
Well, of insurance related to physical risk.
I mean, I think there are big opportunities there, frankly, for insurers to take a different look at new types of insurance products specifically geared toward climate risk. So I think there's going to be challenges in terms of insurers that are going to want to leave certain markets, but then there's also opportunities for others to seize upon.
Yep, great. All right, so back to John and Nicole. I know you've both been part of several of the leading initiatives in the UK, specifically UNEP-FI, and John, I know you're a member of the TCFD task force on climate-related financial disclosures. So what lessons have you learned from being part of those programs, part of the pilots, from the banks who participated, the insurance companies participated, et cetera, that you can share with us? John, I'll go to you first.
Yeah, I think, some of the sort of, bigger challenges have been around, the absence of consistent data around the world. I mean, TCFD is, trying to do that for financial disclosures, but our progress to date has been modest in terms of getting companies to disclose on a voluntary basis. So I think we're going to see the world moving to mandatory disclosure, and that's what's happening in the UK for listed companies. There are a range of methodologies that you can use when it comes to assessing climate risk. So again, getting comparability between them. And in the UK, we're doing a sort of a rather large experiment with stress tests, which kick off this month. So our regulator, the Prudential Regulation Authority, is putting banks and insurers through about 3 months of stress tests. The results will be, out in about October. And I think it's as much to see how much capability and capacity there is in financial institutions to understand how different climate scenarios will affect their strategies, their business plans, their sort of risk profile, a bit of a learning by doing experiment. And I think, together with mandatory disclosure by companies on a rolling basis over the next 24 months, and mandatory disclosure by pension funds over the same period, we're trying to create an environment that says, the companies will disclose the impacts of climate change, the banks and insurers and asset managers will then be able to pick up those disclosures and begin to model what will happen, to, the cash flows of their clients and therefore the underlying sort of credit standing, and also, how we can get it into the more macroeconomic end of top-down stress tests. So I think it's been a challenge. I think there's been a lot of progress made, but, the PRA has been very clear. They want to see this fully embedded by the end of 2021, and I think that is quite a tall order. But Nicole, your reflections from the EU.
Thanks, John. So I think we're in a very, very different place than we have been, let's say, 2 years ago or 5 years ago, definitely. Why is that? First, if I look at regulation, which is obviously in many cases the reason for institutions to start moving, right? John, you already talked a little bit around financial regulation, supervisory action. We see mandatory commitments to TCFD in countries such as New Zealand. We see it in Singapore. We see in the European space, we see the European Central Bank putting out questionnaires to the institutions, EIOPA driving the topic quite significantly, the European Banking Authority launching stress tests across the board on very tight timelines. So there's a massive increase in transparency that will just be created due to the fact that these questions are out there and the central bank stress tests globally are happening. At the same time, I think on a positive spin, it's getting more real, right? So we're not just talking about the financial system as a vacuum. At the same time, we have the real economy changing. We have lawsuits against countries around not being ambitious enough. We've seen this very famous Shell verdict last week around them needing to reduce their Scope 3 emissions, effectively reducing the amount of oil they're putting out of the earth, basically. So very, very tangible commitments that will come into play. Just to give you an order of magnitude out of commitments, we have more than 50% of global GDP already committed to net zero, and more than 50% of global assets under management committed to TCFD and net zero. So there is a market movement that is being created, which is obviously also leading to the risk assessment. So out of regulation, the risk piece is becoming a lot more tangible, and it's becoming a lot more tangible because we see the methodologies also ripen over time. If I may just mention the Network for Greening the Financial System, pushing massively the work around scenarios across the globe in a kind of concerted effort, which will definitely see a significant take-up of regulatory authorities globally, just as one of the initiatives that is going on. We see the same on the net zero side with the UN basically starting to convene all the different net zero asset owner alliances, banking alliances, insurance alliances. So very similar debate. Thus, we're getting a lot more smart around what we need to do, right? So where do we really see material exposures from net zero, from a kind of changing world, so TCFD, from a TCFD world? We know that we need to look at certain industries. We know that we need to look at certain company types or at specific infrastructure, investment, finances, etc. And the market is putting us there. And what I like a lot is we're moving, at least in the European space, but I see that globally as well, much more into the opportunity discussion. So it's not just around, it's a negative debate. We're seeing financing needs that are coming up. We're seeing a lot of clients immediately starting to think about, so where's the money for us? So how can I be part of this transition, maybe drive it, and have the benefits from moving into that direction as well? And am I still providing an incentive for something that might be greener? Or do I start thinking about kind of a negative impact on the ones who are not, especially also driven by the taxonomy in Europe? One last point that I would like to raise in terms of sophistication is the way that the interaction between the financial system and the real economy is working. Just to give you one example, we are fortunate to be part of a project under the German Environmental Ministry together with WWF globally on aligning the real economy and the financial services industries around requirements from the transition and what financing needs might be created, whether or not risks might be created, which will result in an open public tool. And just out of Germany, we have more than 50 real economy companies and more than 30 financial institutions engaging together in creating a better understanding of what really is happening here and how to best model it, but also leverage in terms of financial potential.
That's really helpful, Nicole. Thank you. So I totally want to recap the point you're making, which is there's the risk management integration piece within the banks. There's also the revenue opportunity to finance that transition to a green economy, but that means new products, and new products means risk that needs to be managed. So we're getting a question from the audience here, and Charles, I'm going to come to you. Could you get really tactical? How are banks incorporating climate risk in their risk management frameworks? What are the steps that they're taking? And generally, where do you see them in terms of maturity in that journey, speaking here from the US?
Okay, yeah, and there's obviously going to be some variability between some of the US and European firms here. But generally speaking, what we're seeing in the US is, when firms are looking to integrate into their enterprise risk management framework, they're thinking about how do we identify risks, and how do we measure risks and how do we manage risks. And I think firms are are farthest along on the first point for sure. And we actually did a recent survey of a large number of large US firms, and that survey bore that out. And so firms seem to be sort of moving down the road of developing a risk taxonomy, going through a risk identification process, and trying to assess what level of climate risk they're taking on. I would just note here, that firms are taking a variety of approaches. Some firms from a taxonomy standpoint are thinking of climate risk as sort of a principal risk in and of itself, whereas some other firms are more maybe purists, if you will, about it, and saying, well, climate risk is manifesting itself in an existing risk category, whether it be credit, market, liquidity, operational. There isn't necessarily, a right way to do it, but there is that variety in practice out there as a reality. When it comes to risk measurement, right now, this is where there's probably the biggest variety in terms of where firms stand today, given the challenges and complexity associated with measuring something that is inherently uncertain, where there are data gaps, et cetera. And I think Nicole and Steve are going to, and I'll probably chime in a little bit too on some of the modeling challenges as the discussion continues. And then when it comes to the management side of things, given uncertainty around measurement, some of the traditional management methodologies aren't fully available in terms of limits from a sort of, like a VAR equivalent standpoint, right? But what we are seeing is firms think about, well, to what extent do I want to have concentration limits associated with what we're doing? We're also seeing firms think about incorporating client, and actually have done this, incorporating more qualitative evaluation factors, scorecard type approaches into underwriting approaches. But from a management standpoint, I think the capacity of firms to really embed it into the management side of things will come along as the quality of the measurement improves over time.
That's really helpful, Charles. So when we think about the measurement, we're thinking about the physical risk pathways, the transition risk pathways, and we're also thinking about how do I sort of account for and measure my scope 1, 2, and 3 emissions, particularly if I've made a net zero commitment. So why don't we take the first two, the physical risk modeling and transition risk modeling, and dive deeper into that. We do have quite a few questions from the audience around what the modeling methodologies are in that space and data challenges and the like. So let's start on the physical risk modeling side. Steve, how should financial institutions think about assessing that impact, and what are some of the things that you've learned, given that the insurance sector in particular is pretty mature around measuring hazards?
Yeah, maybe let me start by challenging that last point a little bit, because I think certainly some parts of the insurance industry are pretty mature in this space. Certainly the non-life industry is used to, certainly mature in measuring risk exposure, but climate risk specifically, I would say the non-life industry is obviously farther ahead. And this goes back to the point I made earlier about people just being more comfortable with physical risk than transition risk. Transition risk is sort of a new concept to many of us. So the life insurance industry in particular has done less, I would say, in actually measuring climate risk. And then I don't know if life or non-life, either of them have really wrapped their heads around being able to quantify and disclose climate-related risk kind of separately from the other types of risks that they measure and manage, which is what's being increasingly required or sought by investors and regulators and others. And then you can take it steps farther from there toward actually incorporating it into pricing and underwriting and all those things. So I think the insurance industry still has quite a long way to go here. So starting with that, in terms of physical risk exposure, we're typically seeing companies look at it from a few different angles. So, and ultimately what you're looking to measure and quantify and understand is the impact on business value, and whatever the right metric is to manage or to reflect that for your business is where you need to ultimately get to. So your modeling exercise, you sort of need to decide like where to start and stop, in terms of ultimately getting to that value impact. Physical risk exposures, we're typically looking at impacts on physical assets. We're looking or financial assets that have other kind of physical risk exposures. We're also looking at impacts on business continuity. So there's an operational aspect to physical risk as well. And you should look at your own operations as part of that too. Your own company and your employees. Where do they live? Where are your offices? Where do you have your own operational exposure? So those are some ways that companies are starting to look at physical risks. And there's lots to dive into in terms of modeling approaches and data sources and others. But Nicole, why don't I let you cover transition risk quickly?
Thank you. So I would say across institutions, there's a few best practices that are emerging around transition risk, right? And the core questions are around, if we as the world were changing our emissions footprint, we have at our hands the way that we create demand, we have at our hands the technologies that we employ, and we have at our hands regulation that we put into place to shape behavior in the future. So I think one of the key practices is around, do we really capture all of those in the way that we think about markets in the future? And the fabulous piece, I think, here is it's not about doing something that has never been done before, but rather say, well, I have a certain outlook on a region or a certain outlook on a sector, and how would a climate pathway be different from the outlook that I'm having anyway? And you'll be surprised, in some instances it's very similar, in some instances it's probably not, and it always depends on the industry. And then I think in the next step, the question is where we have a different, where is the financial materiality of that? And then as a last point, so how do I differentiate a good from a bad player in the future? That can be by industry, but then under the industry, it should be on the corporate level or on the infrastructure type level. The wonderful thing here is the same type of thinking is what is required from a net zero view. So I think what we are seeing is a lot more sophistication with our clients and globally across markets. And I saw a question just now around what is happening in Asia, what is happening in South Africa, what is happening, or in Africa, what is happening in South America. So very similar discussions where financial institutions try to enhance their understanding of what is in their portfolio and try to develop, in fact, kind of cutoff points, policy, so limit management and policy management points, and then differentiations on the market side of what they want in their portfolios and what they don't want in their portfolios. What have we seen within UNEP-FI? I think the project that we were able to do with 22 insurers globally have gotten us to a point to think about how can you conceptually approach this, very similar to other financial institutions, but then also how can you make sure that you're not overwhelmed by a perceived complexity? If you look at the transition point I mentioned, I can understand that it sounds overwhelming. So the question is really, how do I manage to cut this analysis short and focus on the core pieces of my portfolio, and then understand the pieces that I actively want to manage in the future. So working with heat maps at that point in time has proven quite relevant. It's not just an industry heat map, it should also have a geographical component because we might be seeing different growth patterns across the globe. But overall, out of the experience that we have over the past many years now, we realize that it sounds more complex than if you're right in the analysis and if we're just complementing the analysis that you're doing anyway. And on the data point, has been a recent FSB consultation with a lot of concerns around data. My impression is that we as a globe are getting a lot more comfortable with approximations, and we know where to approximate and how to do that smartly, and at integrating data that is more related to the fundamentals of the business. So what plans are there, what type of products, what type of technologies are being used, instead of just looking at kind of indirect indicators such as a carbon footprint. Maybe that is a quick answer, and I'm happy to follow up and deep dive further.
Yeah, actually, it looks like there is quite a bit of interest in the questions about diving into the methodology itself. And I know that from your position with UNEP-FI, we were exposed to certainly all the different types of methodologies that folks are going after. And I think that the fundamentals-based approach that we were just describing briefly is a good way to go about that transition risk measurement. So could you maybe go into that just in a little bit more detail? How does a fundamentals-based model like climate excellence, for example, work?
Sure. So in terms of just kind of an easy way of understanding, think about you're currently, and I'm now taking a view from an investment and or a banking perspective. So what we're basically doing is we're modeling the net of a company and their asset value over time in a world that is constituted out of different parameters. So if right now the electricity price is X, if carbon price is Y, if the availability of a technology comes at a certain cost, how would that look if we put this company in an alternative world, just driven by core parameters that are being described in public scenarios such as the International Energy Agency's latest 1.5 degree scenario or any other scenario? So literally, how can we describe the world and how does it change the potential of the company to be successful? Another thing that we do is looking at the company, building, like bottom-up building on which asset it's owning and which technologies it's using in the core profit-generating elements. How would that change moving forward if they were able to adjust to the requirements of a transition? So this is getting us more towards the net zero discussion. So if the company were changing, will it be more profitable or will it not be more profitable? Which is already giving you a pretty significant read and a clear connection point to valuation analysis that are being done anyway. And that's also why we developed this type of modeling with more than 260 analysts globally and University of Cambridge, Oxford in terms of data. So there's kind of a lot of background why we've built it this way. For the banking space, it would be leveraging the same type of thinking, but then implementing it into, if you want to go that far, either into a type of a factor model or into a PD and LGD type of modeling for the elements of the portfolio that might be under most stress. For real estate, you can imagine something similar. For underwriting, the key question is, if I look at, and I'm excluding life right now, and Steve, please jump in here. If I look at kind of the lines of business that I'm having, of course, there will be an impact. Let me just give you one example. If I'm owning a car today, the car might look different tomorrow. So the number of cars is going to change, and then the technology is going to change. And the question is, how would kind of how would my earnings change under the assumptions that there's a certain market growth or less growth than I'm expecting? And how would it change in terms of the risk profile of a car in the future relative to what I'm owning today? So how often will it be driven, for which number of kilometers? And if I have an accident, can I assume that the car will be burning out, or can I assume that I have a residual value, for example? So the logic is more around, how can I look at my lines of business and take sector dynamics into account? What I haven't talked about yet is the macroeconomic view, and we'll also hear about that in a moment. Just, of course, if you look at your current modeling, also on the portfolio level, there's a range of questions around GDP assumptions, unemployment, interest rates, also linking to liquidity risks, which is another layer that needs or should be taken into account ideally.
Thank you.
Steve,
Charles, do you have some thoughts as well?
Okay, please.
Yep.
Yeah. So, maybe taking it for the banking sector and how some of that evaluation can manifest itself. So, for transition risk modeling, Nicole, was describing a very, fundamentals, bottoms-up based approach to evaluating the impact on various sectors and specific players and their adaptability given the firm's strategies, and that really at the end of the day gets you to a change in EBITDA. But as I think, as she alluded to, that change in EBITDA or view of profitability can be used as an input into a lot of the sort of traditional PD models that exist today. So sort of Merton style probability of default models, and that's one of the ways that sort of the newer modeling can be integrated a bit with some of the existing capabilities that firms have developed for capital stress testing, for example, over the years. On the physical side, there's a lot of challenges as well. So there are numerous data challenges, but and there's, if you kind of take a step back, there's an inherent level of uncertainty associated with climate risk related modeling, because we don't have a sort of historical data set to just specify, an econometric model on in the traditional sense. But there are ways to think about that from a physical risk standpoint nonetheless. So we do have events in history where physical risks have manifested themselves, such as, wildfires, floods, hurricanes, etc. And so we do have data sets that show for example, loans backed by real estate, how does the the existence and the severity of those types of events impact the probability of default associated with banks' exposures? And that data can be used to to measure what sort of the additional likelihood of default due to an event occurring and the severity of that event. However, there are sort of some limitations when we do studies on that sort of data. We see that there's perhaps a very pronounced additional level of default that can be explained by the existence and the severity of that event. But the cure rates, for example, can be significantly higher than in instances absent those types of events, and that's frequently due to actions by governmental authorities, relief provided by banking institutions themselves, working with their borrowers, as the regulators would of course encourage them to do. And when we think about climate risk on a forward-looking basis, one of the challenges certainly becomes, what assumptions do you want to make? To Steve's point earlier about the presence of insurance going forward. What's your wrong way risk associated with your insurance? But also, what's the likelihood of government intervention and supportive markets? What's the extent to which they can fully sort of backstop these events, especially as they're, if the likelihood of these events continues increasing over time, and the severity increases over time, or what assumptions can reasonably be made about the ability of governments to provide support to borrowers, and what's the impact that essentially has on recovery rates?
Steve, what are some thoughts from your side, particularly as it relates to insurance sector?
Yeah, first of all, I just want to sort of emphasize that point that Charles just made on the data challenges. I mean, and the impact of regulatory and other actions to kind of prop up markets. It's just, I mean, if you think about it, we're in unprecedented territory, and we're heading into a territory that we've not been before, and it's really difficult to predict how governments are going to continue to act in the future. Going back to some of the points Nicole made from an insurance perspective, there's some really interesting dynamics in insurance overall and the relationship between transition risk and physical risk, both across life and P&C. In terms of companies that insure, have a lot of group business or employer-based business, and sort of how does transition risk impact those employers and sort of what you can expect in terms of future volumes and premiums and retention rates and things like that. And then in the life insurance space, there's some really interesting sort of maybe unintuitive dynamics when it comes to physical risk, and you really have to get down to the product level and look at it at that level of detail. Because if you have, for example, income annuities or payout annuities, they will, and you have an increased physical risk that's going to increase mortality. That will actually be a benefit for those products in terms of financial outcomes, as opposed to life insurance where increased mortality would be harmful from a financial perspective. So it creates some interesting offsetting dynamics, but also some interesting challenges from a communication perspective. And how do you tell that story without seeming really insensitive in the market?
Perfect. So we've talked a lot about the identification and the measurement side. Maybe let's move our conversation into expected impacts or requirements that we're seeing coming out of potentially that analysis. So John, I'm going to come to you first. If we think about a question that maybe is a little bit controversial, that is, what is the strategic impact of some of this measurement? And if we think about sector composition and banks needing to decide potentially who they're going to lend to, insurers may need to do the same. Do you think there's any, debanking considerations and things like that folks need to think about? How are your clients thinking about the impact to their strategy?
So I think there's a sort of two ways of doing it, and I might describe it as the wrong way and the right way. Happening in some areas is a sort of divestment under pressure from the most activist investors and environmental groups. And to do that without analysis, that I think would be the wrong way to do it, because what are you trying to do? You're trying to keep your PR department happy, but you're not actually thinking about your client and your business and how you redeploy the capital you've just given up. So, the best way is to really understand the scenarios that apply to the countries that your client is operating in and, the sector they're in. And so I'll give you an example. And putting aside what the IEA said last week about no new lending in fossil fuels, if you look at future scenarios for the energy sector, fossil fuels will be burned in 2050 in developing countries on a far less level than they are today, but their trajectory down to net zero is to increase for the next 10 years and then sharply reduce afterwards. The same sector in the EU is on a hard downward trajectory in all but a handful of countries. So if you're looking at a global energy company, for example, as a lender or an investor or an underwriter, you've got to understand that level of granularity and understand how your client is reallocating its capital by selling some assets, buying other assets, etc., to meet the regulatory requirements of the countries they operate in, as nested under their commitments under the sort of Paris Agreement and the agreement that will be strengthened hopefully in Glasgow this year. And if you do that, what will happen? Well, probably you'll find some really good opportunities to help advise those clients through an M&A type activity. They may need to raise money, they may need to redeploy money. And therefore, as risk managers and providers of capital, you should be able to support that transition. And that is, I think, a very positive thing for the sector to do. Whereas if you had taken the view that you were going to withdraw from certain sectors, helping that sector transition. So governments drive these policies, companies have to respond to them, and the finance sector is there to support them. And I think that's the right way to think about managing that smooth transition. And we were really clear on the TCFD. What we didn't want was a lack of information leading to people making sudden decisions and causing systemic shocks in sectors in the economy that would come back to the providers of finance. We wanted a smoother transition as is possible, given the uncertainty we've been talking about.
That's really helpful. Let's think about the capital impacts potentially. Are you seeing, I'll go to you, Nicole, institutions setting aside capital to act as a buffer against climate risk? And second follow on to that, is it through the stress testing of their credit portfolios or climate risk under Pillar 2?
Thank you. So if I start on the regulatory side and then look again at the taxonomy and the European Commission's initiatives, right? There's right now a range of investigations and working groups going on around, is there a good rationale for from a regulatory standpoint for requiring different capital or putting out different capital requirements, building on what type of assets people are holding, and maybe use that as a basis or an incentive to enforce the taxonomy. So there is a regulatory, kind of pre-regulatory, let me call it that, discussion already going on, and a way of kind of getting smarter around how hard is the correlation anyway, and how hard it's going to be in the future, given that we can expect the world in which we live to change dramatically instead of staying on the same track and allowing us to kind of predict the future. Secondly, I think the question, and that's relating to, John, what you're also saying, this question is around, if I want to foster the transition in my banking portfolio, in my investment portfolio, let me stay at banking at this point in time, because I think it's most obvious. So if under my banking portfolio, I want to provide an incentive to have my sales teams move into the potentially higher value, and I'm consciously calling it higher value assets, and maybe from a reputational standpoint into the green assets, and move out of others. What is the type of incentive that I'm providing? So we could think about capital allocation or capital requirements internally as well. At this point in time, I'm not aware of any discussion globally where we're already applying this within institutions. At the same time, I think the discussion is quite virulent, especially given the opportunity side around, if I want to be first in the market and if I want to be ahead of the curve, where we see the tipping point from providing an incentive towards putting a penalty on those who will not be able to make it and being the last, let me call it the last man standing, with an asset where my entire syndicate has kind of dropped out. With regard to this tipping point and the regard to the kind of opportunity discussion, we see that debate coming up quite significantly also in banking institutions at this point in time.
Thank you, Nicole. All right, so getting a lot of questions here about the considerations for those who are either in emerging markets or banking and lending in emerging markets. So we are assuming that the transition risk may be higher there. John, do you have any thoughts about considerations in that space?
Yeah, I do, and I'll draw partly on the emerging markets banks that I work for, but also my sort of prior role at leading sustainable finance at HSBC. So I think, you know, there are a number of challenges in emerging markets that if you're exposed to those markets, you face. Firstly, you know, the level of availability of data is significantly less, and certainly the status report we do at the TCFD would back that up. And particularly if you're dealing with you know, a portfolio of sort of mid-market, family-owned, as opposed to very large listed companies. So getting data availability is going to be a far greater challenge, and the data providers would certainly talk about that. I'd also say that for some countries, the adaptive capacity of governments to respond to the physical impacts of climate change, you know, are also much lower. So you may face higher physical risks in the midterm than you might in a country that has put in place you know, sort of mitigation and adaptation strategies. I spent 4 years living in Indonesia and watched the sea come over the seawall in Jakarta more times than I care to think about, as just one example. I think the other thing, though, is that the transition risks are more likely to come a little bit later. Why? Because if you look at the trajectory of the carbon emissions of you know, developing countries, they're still going through their industrialization phase. And the Paris Agreement, with the principle of common but differentiated responsibilities, allows for developing countries to peak their emissions sometime between 2030 and 2035 and then reduce them. So actually, for the next 10 to 15 years, the transition risks could be lower, but clearly trying to avoid you know, putting onto your books an asset that could be stranded as they then have to decarbonize more rapidly is going to be you know, absolutely key. So you know, I'd certainly say adaptation to physical risks, availability of data, and you know, the sort of slower but then accelerating transition risks. The one thing I would say, though, is that the banks that I you know, work with that are exposed to developing economies are taking just a serious approach to putting in place the risk management frameworks, the modelling, trying to get the data, for example. But they're also seeing huge opportunities to leapfrog high carbon infrastructure that could have been built in the next 10 to 15 years with lower carbon equivalents. I liken it to the rollout of mobile phones in Africa that avoided all of the incumbency of fixed line. So no wonder, therefore, that India and China have got some of the biggest installed bases of wind and solar, you know, in their countries, both from a manufacturing and a deployment point of view.
Thank you. Nicole, coming to you, question in terms of the COVID-19 pandemic, have you seen impacts for climate risk considerations from that?
Thank you. Maybe starting to answer at a high level. So I guess the first question is generally, has the ESG debate stalled amid COVID? And we rather perceive a massive uptake given the disruption COVID has caused. Specifically on climate, I think there were a lot of expectation in the markets, at least out of conversations that I was having, that regulatory action and supervisor action would be delayed, and we saw significantly less of that than I think people expected. If I look at the EU specifically and at the Sustainability Reporting Directive, which just came out, which is incorporating TCFD, making it mandatory. If I look at the EFRAG working group providing intelligence to the WEF and to IFRS in terms of future reporting standards, there's a lot less, it's a lot more ambitious than I think a lot of people expected in these times. I think a core assumption that we often see questioned in the work that we do with clients is, do we expect that our emissions are returning to pre-COVID times? For example, look at buildings, do people stay on their home office or not? for example, aviation, do we expect a full recovery or not? So I think that's a little bit of a belief question with a lot of different opinions in the market right now. Where we do see, very tactically, where we do see that the discussion is stalling a little bit out of very good reasons is, just to give you the example, if we are creating net zero strategies and portfolio steering mechanisms at this point in time, which ideally are happening on an entire portfolio, but then on a sectoral level as well, the aviation sector is one of these sectors where we obviously haven't seen as many planes fold. So the technological progress is a lot less than we would have liked to see, or that I think most people expected from the science community. And the question is, will we ever see the recovery of the way of kind of airline travel back to the expectations everybody had when we were formulating carbon emission trajectories? So in this one, I think we're in a moment of pause where we say, well, it's so unclear right now where we're heading. We know that we need to transform, but the timelines are probably under investigation, let's put it this way. So we might want to put the sector on hold for another year or so just to see what is picking up and how much governments are really moving into alternative fuels, etc. at the same time. But generally, I think the message is it has overall rather created an uptake than a downscale of the entire ESG discussion, and the risk debate hasn't really stalled, but rather been pushed ahead.
Thank you. Charles, I'm going to come to you first, and then John, maybe you could add some comments.
Can I add on the COVID question? Just as an actuary, I mean, I think it's exciting. I mean, in a strange way, because it just provides a wealth of data, both from a physical standpoint in terms of what a global pandemic can do to increasing mortality rates, which is one of the effects that we expect will come from increased warming in the long term. So just impacts on global mortality and morbidity provides a lot of data, but then also from a transition risk impact, I think it is a real live case study of sort of how different sectors are affected by a major global event, that might simulate what you could see from regulatory action. So I think it gives us a lot of data to use and to learn from. Thank
you. That's helpful. So one more question here, and Charles, I'm going to come to you first, and John, ask you to come behind. How are you seeing banks dealing with the conduct-related issues, reputational risk-related issues that are coming up from some of the climate risk impacts, where they may be deciding based off of climate or credit to either lend or not lend in certain areas? And Charles, I'll come to you first.
Sure. Thanks, Brittany. One of the things what we think about is that firms take on some reputational risk associated with climate, whether they want to or not, similar to climate risk itself. So in the sense, as firms make net zero commitments, the questions about how are they measuring their progress towards net zero, and any non-compliance with standards that emerge, or taking liberties associated with that, could obviously result in serious reputational damage associated with the firm. And so as firms look to increase the level of disclosure, they're going to need to start thinking about what are the controls and risk management framework we're going to have in place to ensure that our policies and public commitments are being adhered to in terms of both sort of the spirit and the letter of those commitments. The other component, though, and John alluded to this a little bit earlier, is there's also reputational risk associated with stepping back from clients, and what are the second order effects that could have, and so the other constituencies will need to be considered when thinking about big picture issues like debanking. And this is something where there is political pressure across both sides of the aisle in terms of making sure that there isn't a disproportionate effect on certain groups when it comes to the impact of transition, and how can those effects be mitigated over time, and the financing that should be coming along with that in terms of the overall lending footprint of a lot of these institutions.
John, any thoughts from your side?
Charles. Yeah, I mean, I think, I would agree that you've got to take a balanced approach. And sometimes it's quite easy to get very fixated on climate and on, how you transition to net zero. At the end of the day, if you've got a bunch of stakeholders that say we don't want banks to lend to fossil fuels from today, which is what one NGO has said overnight, and then you've got governments that have got policies that will allow fossil fuel lending, and in some countries the energy is required and there isn't a short-term alternative for economic growth, then you're always going to be caught between, different stakeholders, and you can't avoid reputational risk if you define it as not meeting the reasonable expectations of legitimate stakeholders. So I think if you've done the analysis, if you're really clear through your policies and your practices, and if you've trained your people so that in essence, everyone is behind a transition vision that aligns with the countries you're in and enables you to support your clients, that's really important. I did a Risk Minds session in December last year, and we had the CRO of First Rand Bank in South Africa on. And all of the European CROs were talking enthusiastically about net zero and climate risk. And she said, but what about the hundreds of thousands of people we have working in coal mines who, with the best will in the world, are not going to be re-educated into wind farm engineers or solar engineers? We've got to manage a just transition that enables us to re-educate and redeploy and upskill. And that is something that'll take a generation. And so I really think that, a narrow focus on climate, which is a really important issue, shouldn't be done at the expense of the broader ESG issues, and particularly some of the societal and economic impacts.
Thanks, John. That's really helpful. This has been a great discussion. I'm going to come around to each of you and ask, as the folks who are listening to this presentation are all risk managers, what would be sort of your one piece of takeaway for each of these risk managers coming out of this session? Nicole, I'll come to you first.
Thank you. I think my one piece would be create a strong understanding of what climate in the overall ESG space could mean financially out of the net zero and the TCFD discussion, and embed the kind of 5% highest risk into your management as a starting point, which will, I think, create wonderful dynamics in your organization.
Thank you. Steve?
I guess I would say, we're at the point right now where you need to do something, right? So you need to start somewhere. And so I would say get started, and don't let all the challenges and trying to be perfect slow you down and prevent you from doing something that's useful. So typically you could start with a qualitative risk assessment, going through some of the steps that Charles described with risk ID, and do something on quantitative risk assessment. It's not going to be perfect. Companies are not really disclosing that very openly right now, but it's best to get started and understand your exposure so that you can at least start to deal with it internally.
Awesome. Charles?
Yes, mine would be that the complexity and uncertainty here breeds an opportunity for creativity, and there are going to be a lot of different approaches that are developed over time. Nobody has a monopoly on it, and it's a great chance to do some research and exercise your creative thinking in terms of developing new approaches, methodologies, innovations to support this area.
Awesome. John, thoughts from your side?
Yeah, get the first line to do it. If you can involve the people who are talking to their clients, get them to really understand what climate means, gives them the skills that enable them to have that conversation with their clients to work out what that client is going to do. There's an advisory opportunity, there's probably a lending opportunity or an investing opportunity, and then the risk function is there just to put in place the right framework to make it happen. So involve the first line, they'll see the opportunity, they'll manage risk for your clients.
Thanks, John. And then from my side, I'd say climate risk management is fundamental risk management. It's the same skills that are being applied to the existing risk stripes, and the folks here who understand the business, who understand what's happening in the first line, to John's point, will best be able to pull this topic through. So we look forward to continuing the dialogue with all of you. Thank you so much for taking the time with us today. And for any questions we didn't get a chance to answer, feel free to reach out and we can meet offline. Appreciate you. Thank you.